and I hope everyone is ready. They've got their tutorial letter handy and ready for today. So we will be doing learning unit 9, which is consolidation, learning how to consolidate with preference shares. So last week we did for ordinary shares. So there's two things that we covered. It's how to treat the ordinary share capital. Together, how do you also treat the ordinary share dividend? So what we're covering today will also be the preference share holding together with the preference dividend. So I'm hopeful that we'll be able to cover those successfully today. Specifically, as I've said, specifically covering the main parts that I've mentioned for today's class. So let us quickly proceed. So what I'm going to do is I'm going to quickly share important timelines with you. You've got an assignment that's due today according to the information that I have, and also that is the information available on my UNISA. Your assignment 2, please make sure that you are able to complete that assignment. The things that are required, the journal, pro forma journal entries we have covered before. The statement of changes in equity we have covered extensively in all the questions that we did. Most importantly as well, today we'll be covering the statement of financial position. So that's what we will also be covering today. So quickly, I'm quickly going to do a quick presentation. This was also done on your FAC classes, and then we're going to immediately move on and go and do question 1, which is on page 234. So quickly, I'm going to quickly just share my screen. So this is the presentation that has been done in your FAC classes. Very nice presentation. Then immediately we will go on to your study guide, cover some little bit of some theory. Then from there we will move and we will cover the question 1, which is under your exercises. So preference dividends or preference shares. Why is this particular study unit very important? Specifically for you, it's important because you want to learn the treatment of preference dividends during the consolidation. So how do you deal with preference shareholding and preference dividends? So preference shares by nature, you cannot have preference shares if you do not have another classification of shares called ordinary shares. So preference shares, they have a preference right over ordinary dividend. So that's how it works. You initially have to have ordinary shares, then you can then have your preference shares. So the preference shares have got different classification. 1, in terms of financial instruments, they can either be a financial liability or an equity instrument. So specifically for this module, the module looks specifically for the equity instrument part. So we don't focus on the financial liability of the financial instrument. So there's different types as well of preference shares, which is your cumulative preference shares, your non-cumulative preference shares, participation, non-participating preference shares. So we will touch on those quickly and learn about how do you actually treat them when you are doing a consolidation. So one of the things that we will also learn that is important is when we're dealing with preference that is paid and that is declared. So how do you also deal with that as well? So as I'm going to quickly run through this presentation. So cumulative preference shares have a right to preference to the arrear and current dividends before other classes of dividends are declared. So if any dividends are not paid because profits are not available, the cumulative preference shares will always have a preferred right, a preference right over any other classes of dividends that are declared. So in terms of how a preference dividend is, a preference dividend, unlike an ordinary share, so for your ordinary shares, you buy shares, and then you hold shares, and then at the end of the year, out of the profits, then a certain amount of dividends, ordinary dividends, can be declared and paid based on the number of shares that you are holding. Now, for preference dividend, it is different. For preference dividend, the preference shareholding is normally expressed as a percentage of value of the share. So which means the actual amount that you are paying, that you are paying as a dividend or receiving as a dividend, the dividend portion is represented as a percentage of the value of the preference shares. So it's not the number of the preference shares, but it's the percentage of the value. So I want you to hear this correct. Unlike ordinary shares, preference shares say it's the percentage of the value. So in this example, a company has 300,000, 9% preference shares to the value of 400. The dividend, to calculate the preference dividend, it's a percentage of 9% multiplied by the value of dividends. So it's not the number of shares. So it's always expressed as a percentage of value and not amount of shares. So here's an example. A subsidiary has 10% preference shares to the value of 50,000, 40% of the preference shares, and 75% of the ordinary shares owned by parent. So in terms of the statement of changes in equity of a subsidiary, you will have 5,000 dividends paid in the current year. So it's 50,000 multiplied by 10%, which is paid in the current year. And please note, there is nothing that would have been in arrears in the year that these dividends have been paid. If you are doing an analysis of equity of the subsidiary, the preference dividend is 5,000 in the current year. Sorry, if we're looking at the, I'm only going to focus only on the preference dividend. The other example, here is an analysis of a preference dividend. So in the current year, you will have 5,000, which is preference dividends paid, and 3,750, which is the 40% of preference shares and 75% of ordinary shares owned by a parent. So 40% of 5,000 should provide you. So let's just quickly. So 40%, so sorry, I'm just quickly taking a calculator. %40 is 2,000. So this means on the subsidiaries account, in terms of the analysis, if you are looking on the ordinary analysis where there is 75% of owned by a parent, so the preference dividend itself will be 75%, 70 or 75, 75% of 5,000 will be 2,750 and 1,250. This is if you are doing the ordinary analysis. But if you are doing the preference analysis, then you will only apply the 40% of ownership to the parent, and the other 60%, of course, goes to the non-controlling interest. But please note, before you pay any preference dividend, it must flow from profit. So there must be profit makeup first. So we do not take preference dividend into account twice in the two analyses. We merely transferring a profit amounting to 5,000 from the ordinary analysis to the preference analysis so that it can be distributed as a dividend according to the correct percentage. So this 5,000 is taken out of the profit so that it can be properly allocated in the preference shares. So remember to take goodwill and NCI from both analyses when doing the statement of financial position. And here is an example of cumulative preference shares that are still in arrears, but they have been declared. So it's when each year you know how much dividends should be there, but you are basically informed that in arrears for 2 years have to provide. So in the ordinary analysis, we take it out of the profit, and in the preference analysis, we are indicating it as a positive because it's not yet paid. So once it is paid, we indicate it as a negative. So we'll have an example where we will do this. So in the case of a pro forma journal entry, please note that we follow the same principle that we learned about ordinary shares. So there is no difference. So quickly, just a few things that I just wanted to highlight on your side. This is for just giving you more information and knowledge that if the preference shares are cumulative, ordinary owners may receive no dividend in the current reporting period unless the preference is declared. So the most important thing, there must be a legal claim to a preference dividend. In other words, it must be declared. So here is examples of classification or types of preference shares, non-cumulative. If it is not paid in the current year, you are not entitled to it in future. Cumulative means that as it is not paid, it is accumulating up until profits are available to pay for it. This is the ability versus equity. I've already explained this principle, but what I've told you is in this class, all preference shares are classified as equity, and hence consolidation will be done. And it is further recommended when you are doing consolidation of the two capitals, ordinary share capital and preference share capital, that you always draw up two separate analyses of owner's equity, namely one for ordinary share capital and one for preference share capital. So what we are going to do now, time is 4:14. We are going to straight to jump to, I think it's page 235. So I basically want you to read question 1 on page 234 and 235. So I'm just going to give you about 5 minutes. So we will talk again now at 4:20. So please read. Question 1 on page 234 and 235. We'll continue at 16:20. So quickly read that for me. Question 1 on page 234 and 235, and then we will start now again. All right. Let us quickly look at this question. Just a reminder for those who have not yet completed the attendance register to please do so. So you are presented with a condensed statement of financial position of KLTD and its subsidiary LLTD as at 28 February 20.2. What is required to do? We are asked to draft consolidated statement of financial position of KLTD Group. So KLTD Group consolidated statement of financial position as at 28 February 20.2. Remember, it's in compliance with IFRS. Notes are not required. Very important thing in accounting, show all your calculations. So let us quickly now study the information. So we are provided statement of financial position. We can see that we've got land at cost. We have investment at fair value. We've got ordinary shares. We've got preference shares. So please do note these things. This is investment in LLTD. So LLTD is the subsidiary. We've got the number of shares, percentage of shares, the amount. We've got loan to KLTD. So already, one can pick up that this loan thing is going to be a intra-group transaction. So already one can pick up that the loan to KLTD is going to be an intra-group transaction. We've got current assets, trade and other receivable inventories. We've got share capital, straightforward. We've got retained earnings. We've got loan to LLTD. So we know that this is intra-group transaction. We've got current liabilities. So let us read additional information. Pay acquired its total interest in LLTD on 1 March 20.1, on which date the retained earnings of LLTD was 20,000. So what is the year end of this company? It's 20.2. So which means that if you are doing a timeline, it could have started in 1 March 20.2 to 28 Feb 20.2. So this is how our year is looking. Sorry, 1 March 20.1. So this interest was acquired at the beginning of the year. So please take note of that. On the date of the acquisition, it was decided to revalue LLTD's land upward with an amount of 20,000. So this becomes a revaluation surplus. So this 20,000 becomes a revaluation surplus. It becomes a revaluation surplus of 20,000. LTD's preference dividends are in arrears for 20.2. What does this mean? Not yet paid. This is what it means. They are not yet paid for the 20.2 with effect from 1 March 20.1. KLTD purchased some of its inventories from LLTD. So KLTD is the purchaser, is the seller. LLTD is the subsidiary. LLTD sold its inventories to KLTD. The subsidiary sold to the parent at cost plus 33 and a third percentage on 28 February. This is what was on hand, which it had purchased from LLTD. So we know already this is unrealized profits that we need to calculate here. On 2 January 20.2, KLTD sold a non-depreciable asset with a cost price of 10,000 to LLTD at a cost plus 25%. We must take out unrealized profits. So there's unrealized profits that we need to calculate. Cash to the value of 4,000 in respect of the last consignment of inventories that KLTD purchased from LLTD was still in transit. So this means this 4,000 now becomes part of the loan. So one can already look at the loans and see if they are equal to each other. So the loan sitting on LLTD is 20,000. The loan sitting as a liability on KLTD is 16,000. So this is a transaction that needs to be done on separate financial statements. Separate financial statements. So this is something that would need first to be done on the separate financial statements of KLTD. So it becomes the first journal before pro forma journal entries to increase the 16,000 to make it the 4,000. So it's something that we will discuss again. We are also told that each share carries 1 vote. So what is the first step that now we need to take to tackle this question? Where do you start? Anyone? Anyone? So we have to do the analysis of equity. We have to do the analysis of equity. So we know that now we have to do the first one, which is the one that we are used to. And then now we have to study the new one. So let us first tackle the one that we know of. So the first thing that we need to establish in terms of the ordinary owner's equity, we first need to establish the ownership. So we've got here the values of the shares. Then we've got the investment here, which we can be able to apply the number of shares to the number of shares that are sitting on share capital. So one can quickly pick up that there's 32,000. So there's 32,000 shares that K has in LLTD, and the total number of shares is 40,000. And that gives you 80%. So which means KLTD has got a 80% ownership, and on the non-controlling interest there is a 20% ownership. So in terms of now of the at acquisition, so at acquisition now happened on the 1st of March 20.1. Remember, you've been given this information to tell you when did the acquisition take place. So in terms of the acquisition, we've got the ordinary share of 100,000 share capital. So ordinary share capital 100,000. Then we've got the retained earnings at acquisition. We are told that it was 20,000. Now look at the second line on the additional information. You are told that on the date of acquisition, very important that you understand that this happened at acquisition. On the date of acquisition, when KLTD acquired LLTD, it was decided that the value of land, which is 80,000, was supposed to be 100,000. So then the land was valued upwards. So all other assets and liabilities were equal to the fair value, except for land, which was 80,000. And in terms of the valuation that was done, it was supposed to be 100,000. So you are informed here that at acquisition, you had this 20,000 that you need to account for, which is called revaluation surplus. So that means we can easily now take up the percentage of shareholding. For the parent, it's 20%. And then for the non-controlling interest, it's 20%. Right. Now, the next thing that we look at now is what was the consideration of a consideration of the subsidiary, and how much was the non-controlling interest. So the non-controlling interest, it becomes obvious, 28,000. But now the consideration, we will see when we are looking on the investment side of the statement of financial position. So we are told here that the cost price of the investment was 117,000. Remember, the required must not move away from you. you must always keep remembering what was the required. This is supposed to be 80,000. Sorry, I did something wrong there. Now I'm just picking up why the numbers are like this. So the consideration is 117,000, which means that consideration less the goodwill, it's 5,000. So the goodwill is 5,000. So which means you've got assets and liabilities of 145,000. Now I want us to go quickly, go and perform the journal entries for this part that now we have done quickly. So what we are going to do now on the pro forma journal entries, K Ltd group, is we are saying share capital ordinary shares, it's 100,000. Then we have retained earnings, which was 20,000. Then we've got the revaluation surplus, which is 20,000. Then we've got investment, LLTD, which is 117,000. We've got non-controlling interest, non-controlling interest, as we have done the analysis, it's 20,000, 28,000, and then we've got here goodwill of 5,000. Now, remember, why we are doing this is because we are eliminating LTD LLTD's owner's equity at acquisition. So that's basically the reason for this journal entry. So there's two things that I want to keep highlighting is now, because you are doing a statement of financial position, everything else is eliminated, but the new transaction that you have now, it's goodwill, which you must now go and include in the statement of financial position under non-current assets. So I just wanted to highlight that for you, and also highlight amounts that are not easy to just get when you are doing the journal entries. So this becomes pro forma journal entry. Right, let us continue with our acquisition. Sorry, with our analysis of equity. So as we are proceeding with it, we are looking now as to, in the current year, since acquisition to end of current year, how are things looking? So let us see what we've been given. We've been given nothing related to statement of profit or loss and other comprehensive income. So we've been given retained earnings. So which means we have retained earnings, and then we have adjustment, which we need to adjust to. This is retained earnings given, which we need to adjust, and then we have to adjust it against the inter-group transactions that we just spoke about. So let us look at how much was given. So you were told that retained earnings at the end of the year was 34,000. This is what we were told for LLTD. And then we have retained earnings that were given at acquisition. So this is given, this is at acquisition. So it's minus 20,000 because these have been, you must net them off because this is accumulative retained earnings. So let's quickly go look for the intra-group transaction. So one is going to be the loans that will cancel each other. The second one will be, where did I highlight it on number 4? On number 4, with effect from 1 March, which is the current year, KLTD purchased of its inventories from LLTD. LLTD sold its inventories at cost plus 33 and a third percentage. And on 28 February 20.2, KLTD had profits of 5,000 that was sitting, sorry, at inventory of 5,000 that they were sitting with. So now it means we have now to take out unrealized profit on closing inventory, which is 5,000 multiplied by 33 and the third, 33 and the third. I want to think it's been 5%. I'm not sure, but let us quickly see. But please note, you must always capture this information in your calculator. I'm just applying 25% because I know that it's 25%, but make sure that your calculator is the one that you rely on for your exams. Right, this is what we have to take out there to adjust our retained earnings on. Now, on number 3, we are told that preference. Yes.
On that calculation, you're saying is 25%. So for me, I said 5,000 multiplied by 33 divided by 133. It's giving me 1,240. So if you just assume the amount won't be the different and it won't cause problem.
Remember, it's not 33 divided by 133. It's 33.33333 divided by 133.33333. So it's 33.33333
okay.
Divided by 133. Okay. So the answer that you should get here is 1,249.99 and some other numbers, but when you round it off, you should get to 1,250.
Okay, thanks.
You're welcome. So now we are told that LLTD's preference dividends are in arrears. So I've already told you what does this mean. It means they have not yet been paid. That's what this actually means, is that these preference shares have not been paid. So let us quickly, what we must now do, we must now take out the preference dividend that would have been paid out of the profits so that we can take them into the preference shares analysis. So this is ordinary share analysis. So we must take what would have been paid or what is paid out of the profit. So in this case, the profit is our retained earnings. So how do we know how much is supposed to be paid? It is 8,000 multiplied by 13,000. Remember, this is cumulative preference shares. So it is building up. So in this case, we say arrear dividend, because remember, they will not be paid for this year. Preference dividends, and then in brackets, it becomes 8% multiplied by 13,000. So it's 30,000 13,000 multiplied by 8%. This gives you oh, sorry. I am doing this calculation based on the investment. I'm not doing it based on the value of preference shares. So the value of preference shares is 20,000. It's not 18,000. So it's 20,000. It's not 20,000. So I work only on the investment part. So it's on the share capital. So you're calculating it on the share capital and not on the investment. So the share capital is 20,000. So please note of that. So that basically are the adjustments that we are giving over to retained earnings. So I've got a question for you. There's another statement provided here. KLTD number 5. KLTD sold a non-depreciable asset with a cost price of 10,000 to LLTD at a cost plus 25%. Why are we going to include this transaction on the analysis of equity? Yes, I'm all ears. Are we going to include that transaction on the analysis of equity? Right. We are not, that's correct. We are not going to include it mainly because the seller, in this case, it's a parent and it's not a subsidiary. So we only make adjustments only in the cases of a subsidiary who would have made a sale. So basically, this becomes the movement, and your retained earnings becomes 11,000. So we've got retained earnings, therefore, of 11,150, and see the importance of these adjustments that we had to make, including taking out the preference dividend amount out of the profit as well in the current year. So then it becomes easy. The parent shares 80%, and then the non-controlling interest shares the 20%, and then we've got a total that you can make up. So your total assets and liabilities becomes 156,150, and your at acquisition 117,000, since acquisition 8,120, and non-controlling interest 30,230. So now we move on, we go to an analysis equity of the preference shares. So similarly, we need here to do the transactions at acquisition. So we will have at acquisition. So the first important thing is to go and check the ownership. So we see here that we've got 8,000 shares, and we see that the subsidiary has got 20,000 shares. So to calculate the ownership becomes 8,000 preference shares held by the parent over 20,000 shares, and we can see that KLTD will have 40% and non-controlling interest will have 60%. This is just for the preference share capital. So how much is the preference share capital? The preference share capital is 20,000. And we can already make up at acquisition, multiply by 40%. Non-controlling interest multiplied by 60%. Right, then we look at the, for preference share capital, we don't have any other transactions such as revaluation surplus or retained earnings. So we immediately look at how much was the preference shares purchased for. So we can quickly see that when we're looking at the cost price. So 8% cumulative preference shares were purchased for 13,000. 13,000, and we can easily continue to make the non-controlling interest to be 12,000. There is no goodwill for it. So this means that the goodwill for the goodwill as represented by parent consideration becomes 5,000, and therefore total equity becomes 25,000. This is what happened at acquisition. So what I'm going to do, like I did in the other instance, I'm quickly going to do for you the pro forma journal entries for the preference shareholding. So in this case, we have share capital, which is going to be preference shares, 20,000. Which is going to be 20,000. Let's look at analysis again. Then we've got consideration and non-controlling interest. So it becomes investment in LLTD as 13,000. And then you've got non-controlling interest. Non-controlling interest, how much do we get on the analysis of equity? 12,000. So your credit is 25,000, so which means you've got 5,000 here of goodwill. Please note this will have to go to the statement of financial position because that's what we are required to do. So what becomes the journal entry? It is the elimination of LLTV, owner's equity, but now we have to indicate that it's preference shares, and we can also indicate on the first one that it's ordinary shares. Right. So we've worked up to so far. Now let us look since acquisition, what has actually transpired. So since acquisition, there is one thing that we know. So to end of current year, because acquisition happened in the current year. So to end of current year, we know in number 3, LLTD's preference dividends are in arrears for the 20.2 financial year. So it's not yet paid. That's what we know, is that it's not yet paid. So what are we going to do in this instance? It means that we're going to take dividends in arrears. Why are we saying in arrears? Because it's not yet declared. Remember, the 1,600 becomes positive, and since acquisition, the parent has got 40%, and then the NCI has got 60%. We'll discuss this just now. So this means now, in essence, we can quickly go to all journal entries after acquisition, because remember, so far we have done up until acquisition. So the first journal entries that I want us to focus on, we'll have now to look at what else have we been told. So let us quickly look at the analysis, ordinary analysis. Here we had to adjust for this 1,250 of closing inventory. So on the pro forma journal entries, what do we have to do now? We have to have cost of sales, and then we have to reduce the cost of inventories by 1,250 and increase the cost of sales by 1,250. And this is elimination of unrealized profit within the group. This is on closing inventory, if you still remember. Back to the analysis of equity. Here is something else that we are picking up, which is area preference dividends of 1,600. So we will try to do this journal entry when we are actually sitting here with the area dividend. So in actual sense, I will explain this when we are coming here to the preference share holding. So now we can make this journal entry of retained earnings where the profit goes to the non-controlling interest. Remember, you don't do a journal entry for the parent, you only do it for the non-controlling interest in terms of the profit. When you are recording the profit, so you've got retained earnings, you're reducing retained earnings. Because remember, you are adjusting your books on what has not already been reflected. So on your retained earnings, you need to reduce it by 2,230 of non-controlling interest. And then this needs to be on non-controlling interest. We're going to increase the value of non-controlling interest by 2,230. And this is just a recording of non-controlling interest in profit or loss. So we have done all possible journals that we can do on analysis of equity for ordinary shareholding. So owners equity, the preference share side, we have done at acquisition. Since acquisition, this 16,000 is not yet paid, so we cannot have it affect our retained earnings because it's in arrears. It's not yet declared. Remember, we only have a legal claim when it's declared. So the only adjustment that we can be able to do is for the non-controlling interest, because remember, we took a profit and reduced the profit here on ordinary equity. So now we have to adjust again for that profit. So we'll have retained earnings and non-controlling interest. And then we'll have 960. And then we'll have 960. So this is profit because this profit was reduced by the preference shares that are cumulative. So there you've got your 960. So this is journal entries coming out of the analysis of equity. Now let's read the information and see what else other intergroup transactions we pick up. So on the assets and the liabilities, we've got something written loan. Now remember, in terms of the loan, for you to be able to do this journal entry, we need now to take cognizance of that the two balances are not the same. So we go read the information number 6. Cash to the value of 4,000 in respect of the last consignment of inventories. That K Ltd purchased from L Ltd was still in transit. So who's the purchaser? K purchased. So K in this case owes L Ltd. K owes L Ltd. K owes L Ltd the 4,000 of the inventory. So this means in the private separate financial statements of L Ltd, the subsidiary, what we have done in this case is we have said we have recognized the amount that would have been paid of 4,000 because it's cash to the value of 4,000 in respect of the last consignment of inventory. So it's cash. So we would have recognized bank. In other words, if you are going to the statement of financial position, it's cash and cash equivalents. This is what would have happened. So this means that we have debited and credited. So we debit 4,000 cash and cash equivalent. Because now we are not told how LLTD has paid. So we know that if they do not pay in the meantime, we have to raise loan to KLTD of 4,000. So let us quickly see how the loans get affected. So in terms of the loans, you had an asset under KLTD. You had an asset under LLTD of 20,000. Loan to KLTD was 20,000, and on the liabilities, the loan was sitting as as 16,000. So this simply means that when this 4,000 is received by LLTD, this 4,000 will get received by LLTD, and when it gets received, it means that it reduces the amount that was owed. So in this case, we can have elimination of intra-group transaction. So it's loan sitting in LLTD, and this is the loan owed by KLTD. So what is sitting on KLTD's books on the liabilities? It is 16,000. Then it's loan to KLTD. So this one was 20,000 minus 4,000, and then it became 16,000. And in simple words, we say elimination of intra-group loan account. But we cannot have the same thing happening in the same group. So we have identified the first one. Was there a question? All right, let's move on. The next one that we see, it's on number 5. Remember, this is pro forma journal entries. We are told that K sold a non-depreciable asset with a cost price of 10,000 at a cost plus 25%. So what we need now to do, it is to reverse the profit of cost plus 25%. So the profit that would have been realized On sale of property, the books of KLTD, who is the seller, would need now to reduce 10,000 multiplied by 25%, and then we would have to reduce the value of property that has been recognized by LLTD, so that it does not have the 2,500 over. It's not overpriced by the 2,500. So here we are eliminating unrealized profits. Unrealized profit on non-depreciable property LLTD. So we have taken out 2,500 because the property is in LTD. Person was sold. Come on.
Why is it not?
Right. I just needed to quickly mute someone. So I'm quickly trying to look what else have we not covered.
I'm sorry, can I just ask a question?
Yes. Yes, you can. Yes, you may ask a question.
Oh, sorry, I forgot to unmute again. It says there that it was at the cost of 10,000 for the asset, and then it was sold at cost plus 25%. But you only use 20%, 25%. Why isn't also then 25 over 125?
Can I get your question again? Why is it not?
You used up the amount for the 10,000 times 25% for the asset, which I understand, but why isn't it also then 10,000 times 25 over 125?
I'm sorry, I missed your question. You're saying that you can follow the unrealized profit that was calculated.
Yes, I understand. You took the 10,000 and you times it by 25%, which gives you then 2,500. Okay. But why don't you use 10,000 times 25 divided by 125 as the formula? Like you do in inventory.
In this particular instance, I hear your question very well. In this particular, so on inventory, you're asking why are we not just taking out the 33.1% out? And in this case, why are we taking only the 25% and not taking out 25 over 125? Now, this is the difference. I want us to read this question again. So on the other side, we are also on the inventory side. Inventory is something that is on the ordinary activities of being sold, whereas things such as property are things that are hardly in your what you call in your ordinary activities that you are selling in the business. So inventory, in terms of the cost plus pricing, when you take out the costing that has been added on the cost price to make the selling price, you always have to remove it by saying 25%, sorry, 33.1 and a third divided by 133 and a third. And now when we are looking in the case of a 25% of a parent, we are also told that it was sold at cost plus 25%. So in this instance, we were supposed to be taking out 25 divided by 125%, so that we are able to get to how much exactly would have been the profit, and the profit in the calculation would give you 2,000 instead of 2,500. I hear you very well. Let's hold on to the question. We'll come back to the question. I tend to want to agree with you that this should be 25 divided by 125. But I'll come back to you just before we end today's class. If failure on that, on the next class, this will be the first thing that I will address. But let us proceed. Because I'm trying to also pick up this on learning unit 7, where we started to introduce the issue of property that is held within the same group, to try and pick up that trend. But in those instances, would have been given exact amount of profit that was already made. So yeah, definitely a very good question. So I'll come back to that question back again. Because I'm picking up a similar question on page 138. So it's 137 of your study guide. So I'll quickly go to it. Just for consistency, it's 137. So this is example 3. So in an example 3, it's a parent that sells that though it's a depreciable asset, but I just want us to follow a similar thing. Here we are told that BLLTD purchased all of its machinery at a cost plus 33.3%. So in this case, it means that we need now to calculate the unrealized profit. Let's quickly move on to the calculations. Let me quickly see your comment. I hear the question, but the price that the property would have been sold at ESO would have been a selling price as well in the case of property. So if you are looking in this case, when the profit was calculated here, it was 33.3 divided by 133.3. So I'm inclined to also believe that we must say 25 divided by 125. So as I said, I will come back to that, but I believe it is 25 divided by 125. I'm just looking for the page where we were, 233. Yeah. So this is supposed to be 25 divided by 125. As I said, I will try to investigate it as well further on my side, but I still believe the query is correct. This is supposed to be 25 divided by 125. But we'll come back to this thing on the next class just to confirm that the principle that we have used as well is correct. So we have covered everything. We must now go to what we were required to do. So in terms of the statement of financial position, we are given property, plant, and equipment. So it's property. So remember, in terms of IFRS, you have to write everything in full. So you have to show in calculations what exactly you are adding. So in this case, we've got 80,000 plus 75,000, which becomes the easy part. Remember, land and buildings is actually what is making up of PPE. So it's 80,000. 80,000 plus 75,000. So I'm going to add the revaluation provided of 20,000 minus 2,000 of unrealized profit. Which is 173,000. Then you have your goodwill. Please remember that goodwill. So we've got it as 5,000 from ordinary shares plus 5,000 from preference shares, and we've got 10,000 goodwill. Current assets, we've got other receivables. Straightforward, it's 30,000 plus 53,000. So this is 83,000. We've got inventories. So inventories would be 15,000 plus 19,000. And now we have to take out the unrealized profit that we calculated earlier, which was 1,250. Sorry about that. And then we've got cash and cash equivalents. So what is making up our cash and cash equivalents? Remember, it's like 4,000 that is in transit. Then we've got total assets. Making up 302. And 750. Then under equities and liabilities, we've got share capital. Our share capital is made up of ordinary shares, and it's made up of preference shares, and we're only taking the parent one, which is 140,000. We've got the retained earnings. And our retained earnings is going to be 45,000. Plus, now we need to go now and look at other values that are making retained earnings. So it's going to be minus 2,000. What is the 2,000 for? Remember, it's for the profit. It's for the profit that was already made. It's for the profit that was already made when we did the calculations. So it comes from that one. When we sold the property, 2,000 plus, let's quickly look. We've got 8,920, and then we've got 640. Eight 920 plus 640, which gives you 52,560. Then you've got your total giving you 192,560. Did I do something wrong? So then you have your non-controlling interest. Forgot here that you show how your amount is made up of. It's 100,000 plus 40% plus 40,000, which gives you 140,000. Then the non-controlling interest, we can go and take it and add the 32,230 and 12,960. $32 plus 12,960, which gives you 43,000. Which gives you 43,190. And that's basically how to get your total equity. Total equity of 235,750. Non-current liabilities, do we have anything? I only see current liabilities. I don't see anything about non-current liabilities. So under current liabilities, what we have, trade and other payables. So what is trade and other payables? It's 54,000 plus 13,000. Which is giving you 67,000. Total equity and liabilities gives you 302,750, which then balances. So the most important thing now is this 10,000, where if it's saying cost plus, we treat it exactly the same as inventory, as per example 3 that I've provided on learning unit 7. And in the meantime, I'm just going to find if there is any inconsistencies with what we have done here. And I will provide you an opportunity as well if you've got any questions. So I will remain as well. But that's basically it. So for question 2, if you do more practice, you will find out that for question 2, you have to follow the same route of taking out preference dividend out of the ordinary owner's equity analysis, and then you have to include it when you are doing the preference share, and then you have got to, if it's paid, then you have got to indicate it as a negative. So it is simply transferring. So you're taking preference dividends from profit, and you're including here as a positive one line from profit. So it becomes profit attributable to preference owners. And then if it is paid, you then indicate it by a negative. So if you try and attempt to do the questions that are covered in question 2 and question 3, you will find out that they will give you that context in terms of being able to get the profit and to be able to do the preference share after it's paid. So what I'm going to do is I'm quickly going to check the consistency on calculating the unrealized profit on property. And whilst I'm doing that, I'm quickly going to share this with you, that you quickly complete the evaluation in the meantime. And I quickly check that consistency in terms of what, in terms of how you should be treating unrealized profit when you are provided a cost plus narrative in the question. So we'll be with you just now again. In the meantime, please complete the feedback in terms of the evaluation. Yeah, quickly, I have also spotted a similar question. So how we have done it in our case is actually correct. So I've spotted a question, which is question 14 on tutorial letter 102. So question 14. So previous. So on question 14, specifically under additional information, you are told here that Pink Ltd purchased equipment from Panther at a cost price plus 10% for an amount of 220,000. Both companies depreciate equipment at 10%. So if we go on and we look how did they treat this information of this 220,000? Here is where they calculated the unrealized profit of 220. It was 10 divided by 110. So if you will be looking under your solutions as well, you will pick up that that is definitely an error. And I will be sharing it as well on my side with the lecturing team so that they are aware of this error. But I quickly want to check on my UNISA as well if there was nothing that was shared before, specifically on announcement, if there was no errata that was shared. Right, I'm not sure why this was not shared, but of course I will share it with them. But thank you very much. Please keep well. We will be having a class again on cash flows next week on same time, which is the 7th of October. Same time we'll have the class. We will cover the cash flows. Please prepare yourselves enough, or will it be going for almost 3 hours for that particular class, and it is also the last class. So if you've got any questions, please bring them on that class. And secondly, please take advantage of the FACET class that will be presented on Sunday, which will provide you more preparations for exams. So thank you very much. Enjoy the rest of your evening. Thank you. I'll be available for a few minutes if there is any further questions.